Welcome to the Deep Dive. Today, we're plunging into a company that, well, it recently splashed across headlines with some truly surprising earnings. But like always, there's usually a much deeper story beneath the surface. Okay, let's unpack this. We're doing a comprehensive look at MARA Holdings, Inc.'s Q2 2025 earnings. Our analysis, it comes from a structured framework, integrating official company data with real-time market expectations. Our mission, pretty simple. Get through the noise, extract the really important nuggets of knowledge, and give you a shortcut to being well-informed about MARE's recent performance.
And that's exactly why this kind of deep dive is so critical, especially in volatile markets or with companies like Emera, which, let's face it, have pretty unique financial structures. It's just incredibly important to look beyond those immediate headlines. Understanding that full picture allows you to distinguish, true operational health from those one-off events that can really distort the narrative. So this deep dive, it'll offer multiple perspectives, hopefully lead to some aha moments, all without, overwhelming you with information overload.
Right, let's kick things off. Now for slide one. The at-a-glance scorecard. This is where we get that high-level view, right? MARA Holdings headline performance against what Wall Street was expecting. And the numbers, wow, they truly jumped off the page. They reported total revenue of nearly $238.5 million. That blew past the consensus analyst estimate of around $228.9 million. So a beat there, but the real showstopper, the one that generated all their shocking earnings headlines, was their diluted earnings per share, or EPS. MARA announced a diluted EPS of $1.84.
Yeah.
Now, this was a monumental beat compared to the consensus estimate, which was actually for a loss of 2.249 per share.
Huge swing.
Huge. Interestingly, though, on the day of the earnings release, July 29th, MARA stock actually closed down a bit, 2.24% during regular market hours. Now, that was before the announcement. But after the bell, you saw analyst sentiment just flip. Overwhelmingly positive headlines screaming exceptional, massive profit surge. So when we look at this year over year, the Q2 2025 numbers versus Q2 2024 are pretty stark. Total revenue up a solid 64.4%. Okay, that's strong. But net income, it swung from a loss of nearly $200 million last year to a gain of over $800 million this year. That's a jaw-dropping 504.7% increase.
Just incredible numbers on the surface.
Right. And diluted EPS went from that loss of $1.72 to a gain of about $0.84. A staggering 355.6% jump. So, okay, the revenue beat sounds solid, respectable, but that EPS jump from a loss to a profit of $1.84, that's truly staggering. What was the real secret sauce behind that incredible swing?
Yeah, what's fascinating here, and you pointed it out, is that dramatic disparity. The gap between the revenue growth strong at 64.4% and that net income surge over 500%. That kind of massive gap immediately signals that something, beyond core operations was likely at play.
Right, something unusual.
Exactly. And if we connect this to the bigger picture, the primary driver behind this outsized profitability wasn't actually mining more Bitcoin efficiently. It was a non-operational, non-cash event. When you dig into their financial reconciliation, there's a gain of approximately $1.18 billion. And it's related to what they call a change in fair value of derivative instrument.
Okay, derivative instrument. Can you break that down a bit?
Sure. Think of a derivative as just a financial contract whose value is derived from something else, in this case, likely tied to the price of Bitcoin itself, or perhaps interest rates, things like that. So this huge profit surge wasn't really from digging more Bitcoin. It was more like a favorable shift in the market value of these financial positions they held. It significantly inflated those headline gap numbers. It's almost like, finding a hidden treasure chest in your company's books that boosts your reported wealth, but it isn't from your day-to-day work. It didn't bring in operational cash.
Okay. That makes sense.
And, to fully grasp these profitability figures, it's also important to understand the difference between basic and diluted EPS. You mentioned diluted EPS. So basic EPS, that's just net income divided by the outstanding common shares. Pretty simple. But diluted EPS, which is what MARA rightly uses here, it gives you a more conservative and, frankly, realistic view. It adjusts the calculation to include the impact of all potential new shares that could be created from things like convertible debt, stock options, warrants. For a company like MARA, which often uses these kinds of financial tools to fund growth, diluted EPS offers a much more accurate assessment of what's truly available to the common stockholders because it reflects that potential future dilution.
That makes a lot of sense. So while the headline screamed massive profit surge, it wasn't all about, digging more Bitcoin out of the digital ground. To truly understand MARA's financial health, we really need to go beyond the surface. Which brings us to slide 2, the engine of profitability. And here it sounds like it's crucial to understand the difference between those official GAAP numbers and the non-GAAP metrics they also report.
Exactly. It's critical here. So while Mara reported that GAAP net income of over $800 million, they also present a non-GAAP measure called adjusted EBITDA. They argue, and many analysts agree for miners, that this better reflects their core operational performance. For Q2, their adjusted EBITDA was huge, nearly $1.25 billion. Now, the bridge between these two figures, GAAP net income and adjusted EBITDA, that's where it gets really insightful.
Okay.
The company's reconciliation shows several key adjustments. They add back depreciation and amortization. That's a standard non-cash charge for wear and tear on assets, mining rigs and buildings. They also add back stock-based compensation, another non-cash expense. But the most significant adjustment, and this circles back to what we were just discussing, is that massive change in fair value of the derivative instrument. That $1.18 billion gain, which massively inflated the GAAP net income, it's subtracted out in their adjusted EBITDA calculation.
Oh, okay. So they remove it for adjusted EBITDA. Wow.
Yeah. Well, management removes this gain because it's tied to financial market fluctuations, not their core business of actually mining Bitcoin or managing energy. And crucially, it didn't represent operating cash generated during the quarter, so they pull it out to show, supposedly, a clearer picture of operations.
Okay, but even adjusted EBITDA seems huge then, at $1.25 billion.
It does, and that's the tricky part here. In this specific case, neither GAAP net income nor adjusted EBITDA gives you a perfectly clean picture of just the core mining business's profitability. Why? Because of that massive distortion from the derivative gain impacting both numbers, just in opposite ways in the reconciliation. So to provide perhaps a clearer view of the core operational margin, you can sort of back into it. If you take their revenue, roughly $238.5 million, and compare it against an operational profit proxy, which you can estimate by looking at adjusted EBITDA before some items, but definitely after removing that derivative impact, you get something different. Let's say, very roughly, you isolate the operational components. You arrive at an operational profit proxy of approximately $60.6 million for the quarter. $60 million. Compared to the $800 million GAAP profit, or $1.25 billion adjusted EBITDA.
Exactly. It's a stark difference. Now, when you measure that $60.6 million against their revenue of around $238.5 million, it yields a core operational margin of about 25.4%. This calculation suggests that while financial market movements created that record-breaking headline profit, the fundamental business mining Bitcoin, managing energy, operated at a healthy, yes, but much more modest 25.4% margin. It gives you arguably a more stable and representative view of the underlying business's ability to generate profit from its main activities, separate from financial market swings.
Wow. Okay. That's a huge distinction for anyone trying to really get a clear picture of their core business performance. So with that context in mind, let's turn our attention to the actual nuts and bolts of their operations. Let's go down to slide 3, the engine room business segment performance. This section, I understand, focuses on the key performance indicators, the KPIs, for scale, efficiency, and cost effectiveness of their whole integrated infrastructure. Right. And a primary driver of Emhari's revenue potential is just the sheer scale of its computational power, its hash rate. They reported a really impressive 82% year-over-year increase in their energized hash rate, reaching 57.4 exahashes per second, or EHs, at the end of Q2 2025.
57.4 exahashes. Remind us quickly what hash rate means in this context.
Sure. Hash rate in Bitcoin mining, it's basically the measure of the total computational power being used across the network, or by a specific miner like Emory, to solve those complex mathematical problems. Solving those problems validates transactions and creates new blocks on the blockchain. So think of it like the number of lottery tickets a miner holds in this continuous global contest to win newly minted Bitcoin and transaction fees. A higher hash rate directly increases your probability of winning those block rewards.
Got it. More computational power, more chances to win Bitcoin.
Exactly. And this substantial growth in hash rate was critical because it enabled MARS to actually increase its total Bitcoin production by 15% year over year. Now, that's a significant achievement, especially when you remember the Bitcoin Network's halving event back in April 2024. That event cut the block reward for miners literally in half. So despite that major headwind reducing the prize, MARA's strategy of aggressively expanding its operational footprint, its hash rate, successfully offset those network-level challenges, allowing them to still produce more Bitcoin than last year.
That's impressive execution, managing to grow production through the halving. What about efficiency? Mining is notoriously energy intensive.
Absolutely. Efficiency is paramount. And here, MRA also showed strong progress. They reported a 26% year-over-year improvement in its fleet efficiency. They reached an average of 18.3 joules per terahash, or JTH, in Q2 2025. Now, JTH is the industry standard for energy efficiency. You can think of it like miles per gallon for a car, but here, a lower JPH figure is superior.
Lower is better, means less energy used per unit of computation.
Precisely. Lower JTH means lower electricity costs for the same mining output. And this gain, they say, is a direct result of their strategic fleet upgrades, specifically the rollout of newer, more efficient miners like the S21 Pro. The impact is clear. They state that 60% of Marae's current hash rate is now generated by these highly efficient miners, defined as under 20 JTH, which directly reduces the cost to produce each Bitcoin. That's key for profitability, especially post-halving.
Makes sense. Scale up and make each unit of scale more efficient. What about this vertical integration aspect?
Right, that's another cornerstone of MRA's strategy. It's this shift toward vertical integration. It means they're increasingly owning and operating the full stack of their infrastructure, everything from power generation in some cases right through to the data centers housing the miners. They now have over 1,100 megawatts of total operational capacity. And significantly, more than half of that, 599 milliW, is at sites they actually own and operate. This reflects a major strategic transition. They went from basically 0 owned and operated sites not too long ago to now roughly 70%.
Can you give an example?
Sure. A prime example is their 114 milliW wind power facility they acquired in Hansford County, Texas. By owning renewable generation assets like this, MARA is trying to transform itself. They're moving from being just a simple, large electricity customer where energy is often their single biggest expense into a more sophisticated energy manager. The strategy here is twofold. 1, de-risk the business from volatile energy price swings in the market, and 2, secure lower cost power over the long term. Plus, it creates a platform for potential future energy services, aligning with their broader digital energy narrative we'll touch on later.
That vertical integration really does sound like a potential game changer, giving them much more control over their main cost input. Okay, let's move to slide 4, financial strength and shareholder rewards. This section is all about assessing the health of MRA's balance sheet and understanding their rather unique approach to capital returns.
Yeah, unique is a good word for it. MRA concluded the second quarter in an exceptionally strong financial position, liquidity-wise. They reported combined cash and Bitcoin holdings of approximately $5.4 billion as of June 30, 2025. That's a lot of firepower. And this impressive liquidity was actually further enhanced after the quarter ended. They issued nearly $1 billion, $950 million in convertible notes. So that brings their total pro forma liquidity cash plus Bitcoin plus proceeds from the notes to over $6 billion.
$6 billion in liquidity. How leveraged are they, though? What about debt?
Good question. We can look at their debt-to-equity ratio to get a sense of leverage. Using the end-of-quarter balance sheet figures, total debt was around $2.67 billion, and total equity was about $4.8 billion. So the calculation debt divided by equity comes out to about 0.56.
0.56. How should we interpret that?
Generally, a ratio below 1.0 is considered moderate to low leverage. So 0.56 indicates that MRA's assets are financed more by capital from its owners, the equity holders, than by creditors or debt holders. It's usually seen as a sign of a healthy and relatively stable balance sheet structure, especially given the capital intensity of their business.
Okay, strong liquidity, moderate debt. Now, this raises that important question you alluded to. What about shareholder rewards? You don't see traditional cash dividends or big share repurchase programs from MRA, right?
Right. They have a very unconventional approach here. Unlike many mature companies, MRA doesn't return capital via dividends or buybacks. Instead, their strategy for creating shareholder value is really twofold, and it's deeply integrated with their core business. First, aggressively accumulating Bitcoin on its balance sheet, and second, by actively managing that huge Bitcoin asset to generate yield.
Okay, let's break that down. First, the accumulation part.
Right. Let's call it the Pado deal and accumulation strategy. A primary component of Mara's value proposition, arguably, is its strategy of holding on to the Bitcoin it mines. Their Bitcoin holdings grew an incredible 170% year over year to nearly 50,000 BTC by the end of Q2. That's a massive amount of Bitcoin. This ODA deal, which stands for Hold On for Dear Life in crypto slang strategy, essentially allows shareholders to gain exposure to the potential long-term price appreciation of Bitcoin just by owning MRA stock. You could almost think of it like a built-in Bitcoin ETF, but with the added layer of operational leverage from the mining business itself.
So part of the investment thesis is just holding the Bitcoin, but you said they also actively manage it?
Yes, they don't just let all of their Bitcoin sit idle in cold storage. This is where the active treasury yield strategy comes into play. As of June 30th, they reported that approximately 31% of their holdings, which is about 15,500 BTC, were activated. Activated through things like lending arrangements, structured trading strategies, and using Bitcoin as collateral for financing. The stated goal here is to generate incremental income that can then be used to help fund operations, expand their infrastructure, or potentially reduce the company's overall cost of capital. They highlighted an expanded partnership with an asset manager called 2 Prime for this. It represents a pretty innovative form of capital management, maybe even capital return, using the company's core asset, Bitcoin, to fuel further growth without necessarily needing to sell that Bitcoin or issue excessive new equity.
That's a fascinating way to use their primary asset, really leaning into the financial side of managing Bitcoin alongside the industrial mining side. Okay, finally, let's wrap things up and look ahead. Slide 5. The road ahead management's outlook and key takeaways. So what does this all mean going forward? What is management's outlook for MRR? Are they just a Bitcoin miner anymore?
That's the key question. And management's commentary and their recent strategic initiatives, they signal a clear and quite ambitious vision that definitely extends beyond just pure play Bitcoin mining. The company is actively positioning itself, in their words, as a vertically integrated dispatchable digital compute company. That's quite a mouthful.
Dispatchable digital compute, what does that mean?
It's built on several key pillars as they lay it out. First, there's the continued focus on energy infrastructure and innovation. Their stated mission here is to deploy digital energy technologies to advance the world's energy systems and, importantly, to monetize excess energy. They want to provide flexible load to help balance power grids. This reframes their data centers not just as Bitcoin mining facilities, but as potentially strategic energy assets that can interact with the grid.
Interesting. What else?
Second, they have clear high-performance compute, or HPC, ambitions. They're forming strategic partnerships to try and capture opportunities in the broader technology market. Particularly, they're targeting the energy-intensive AI sector. For example, they mentioned a collaboration with LG-backed Pado AI focusing on next-gen data center power management solutions, and another partnership with Google-backed TAE Power Solutions for building modular high-frequency load management systems for hyperscale energy demands. This indicates a clear long-term strategy. They want to leverage their infrastructure, their energy expertise to serve HPC clients, potentially big AI clients, beyond just the crypto ecosystem. They're trying to become a power player, literally, in the AI compute space.
Mining, energy management, and now potentially AI infrastructure.
And third, they're also expanding into institutional Bitcoin services. By formalizing and expanding that relationship with the asset manager 2 Prime, MRRA seems to be turning its internal treasury management capabilities into a potential external business line. The goal is to advance institutional Bitcoin yield strategies, essentially leveraging their own in-house expertise to serve a growing institutional market that's looking for sophisticated Bitcoin financial solutions.
Okay, quite a broad vision unfolding. So bringing it all together then, what are the key takeaways from our analysis of this quarter?
All right, let's summarize. First, a massive headline beat driven by non-cash gains. Yes, MRA shattered estimates with that $1.84 EPS, but remember, it was overwhelmingly driven by that non-operational, non-cash $1.18 billion gain from derivatives, not core operations. Second, core operations demonstrate impressive growth and efficiency. Beneath those headline numbers, their 82% hash rate increase and that 26% efficiency improvement were real. They allowed MRI to grow Bitcoin production despite the halving, which definitely strengthens their competitive moat in the mining space. Third, a strategic pivot into a digital energy and compute operator is underway. This is key. Their investments in owned renewable power, the vertical integration, and those partnerships with AI-focused energy tech firms signal a clear ambition to become more than a miner. They want to be a vertically integrated infrastructure company, potentially creating new long-term value drivers beyond just Bitcoin's price. And fourth, a fortress balance sheet fuels aggressive growth. With over $6 billion in pro forma liquidity, they have a formidable war chest to fund these ambitions. However, it's important for investors to note this strength has been built partly through capital raises, like those convertible notes, which always introduce the risk of potential future shareholder dilution down the road.
So it seems like two stories playing out simultaneously.
Exactly. The final narrative for Q2 2025 for MARA really tells two parallel stories. One was about, you could say, financial engineering, where favorable market movements in their derivative portfolio produced that stunning, headline-grabbing profit. The second story, and arguably the more critical one for the long-term value of the company, was one of industrial execution. The company demonstrated tangible progress on its core mission, building a resilient, efficient, and vertically integrated digital infrastructure platform by successfully scaling its hash rate, driving down energy costs through efficiency and ownership, and forging these strategic partnerships in energy and AI. MARA is laying the groundwork. They're building for a future where its value might be defined not just by the Bitcoin it mines day to day, but by the sophisticated energy and compute infrastructure it commands.
So here's a final thought to leave you with. What if the future value of a company like Mara isn't just about the price of Bitcoin anymore? What if it's increasingly about its role in this evolving landscape of energy, grid stability, and high-performance computing, especially for AI? It's something to mull over as you think about how companies in this space adapt and potentially redefine themselves. What other insights would you like to unlock?
And remember, this kind of structured approach we use today, breaking down the earnings report, looking beyond headlines, understanding GAAP versus non-GAAP, checking operational KPIs, it's applicable to analyzing any company. It really helps you build a deeper, more nuanced understanding of your investments.
Absolutely. Now, before we wrap up, we have a couple of important disclaimers for you. First, this deep dive is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. All investment decisions should always be made based on your own research and in consultation with a qualified financial professional who understands your specific situation. Second, this deep dive was generated by an artificial intelligence model. While it's designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information presented, including financial data and any calculations, should be independently verified by you, the user, before making any decisions based upon it. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.